Good morning. It's February 8th, and we're going to take a look at three portfolios, how they did last week, and how they're doing year to date. The first portfolio is going to be the monthly dividend return. It's a dividend portfolio, and we're going to see how it performed last week and how it's performing against the S&P, which is the market. So the S&P has been up 3.2% this year. The monthly portfolio is up a little better. It's up 3.7. The monthly portfolio is a safe, high yield, relatively high yield return dividend portfolio. It has 5 positions. Each position is reasonably priced. The first position is MFS International Income Trust. It's like $3.84. The second one is PPT, Putnam Premier. It is like $5. The next one is MFV Special Value. It's $7. So none of these are really expensive. The last Friday the market was down. This was actually up. The market was down 5.4%. This was up 0.54%. So it's doing well. Last week it was at 2.5. This week it's 2.5. And this week it's up 3.7. So it's up 48%. It's a small number. But by the same token, it is up. And more importantly, let's see how it's doing against the S&P 500, which is 3.2 to 3.7. It's beating the S&P 500 by 15.6%. So it's robust. It gives you market-like returns without a lot of ups and downs, and would be a good investment for people wanting to get into the stock market. They're afraid of what the stock market's doing, but they want to make a decent yield. And also it would be good for retirement accounts, IRAs, Roths, because it throws out a yield, and that yield would be taxable. So what you would actually end up getting at the end of the year would be this less whatever your tax bracket is. The second portfolio we're going to look at is the passive income. It's actually a passive income portfolio on steroids because you get growth in the stock and you get a yield. So far this year it is up 8.2%. It throws out a 12.4% yield, which is good. You could consider that passive income because it's a big enough number to actually make a difference. It's got a 6.3% beta, which is good. So last week it was at 5.2, and this week it's at 8.2. So it is increased 57%. But once again, it's a fairly small number. But the trend is up, and it's up, pretty well. So let's bounce that off against the market, and it's beating the market by 156%. So once again, this would be a good portfolio for IRAs, Roths, because it does throw out a 12% yield, and that could hurt at tax time. It's got a design 6.3% or 0.63 beta, which means I only select stocks in my scans with a low beta because it can make a huge difference for long-term investing. So it's done well. Had a good week, and the next one we're going to be looking at is the stock portfolio. Now, this portfolio I came up with because people need a portfolio where they're not going to get a tax hit at the end of the year, and where the dividends and the passive income are great, but when you figure out what you're going to net out, they're not as great. So you have to look at what your taxable income is, and then work with that. So this portfolio has 8 rows, and these stocks were selected in a stock screen, and I'll show you what I mean by a stock screen. I use this screener, which is the relative strength 3. So what I do is I screen for criteria, and then I quantify the criteria, and this is called a quant screen. So when you hear about quants, this is a quant. I screen for low beta, once again. It's very important for long-term investing. I look for income, and I'm looking for characteristics of how the stock moves. I mean, technicals and fundamentals and all that are great, but at the end of the day, the market is not trading on technicals or fundamentals. It's trading on news. So with that in mind, I look at more performance with less market risk, which would be the beta. So the percentage increase this is 13.1. So this is beating the market by 309%. So that's a significant number, and this, like I said, is appropriate for just regular investing where it's not in an IRA, it's not tax sheltered, and you can get decent returns without a lot of market risk, and maybe retire earlier. I mean, that's what we're all looking for. And historical returns, it's done well. 1 day return is obviously not very good because it was down, but 5-day, 10-day return at 2.1 month is 11%. So this is robust. It's something you could use for a more long-term investing position. So, and lastly, I'd like to have a shout out for the Stockrover portfolio, or the program. It is absolutely incredible. You can do scans, you can do comparisons, you can do benchmarking, you can see what's going on in the market, like indices. You can see which indices is doing well, sectors. It gives you a good feel on what's going on with sectors, real estate, what's working, what's not. So it's like the Swiss Army knife of investing. It is awesome. I will leave a link on my page, and you can take a look at it. But if you're really serious about investing, this is what the pros use. This type of analysis is really helpful to long-term investing and taking the luck out of it and putting in skill. So that's it for today. Next week I'm starting a safe long-term investing series that shows you how to do long-term investing in a market that really doesn't trade on fundamentals or technicals. It just trades on news. How to deal with that. How to realize your financial goals long term. So once again, thank you for listening, and I will be back next week and we'll start the new series. Thank you.